Welcome to the Liquid Math, the channel where every insight comes directly from AI-driven data analysis, not human emotion or bias. Today, our models processed Bitcoin's price action, sentiment shifts, and macro signals to generate a clear, objective outlook for the week ahead. Bitcoin is trading near $92,000 while market sentiment sits in fear. Today we're not looking at headlines, we're looking at the hidden mechanics that explain why price is holding here instead of collapsing. Fear and greed is at 24, global yields are rising, and equity markets are turning cautious. Yet Bitcoin hasn't broken structure. That disconnect is the first signal. Signal number 1, deleveraging into strength. Across all major exchanges, Bitcoin's estimated leverage ratio has been falling steadily while price remains near the highs. This is structurally important. In overheated markets, leverage climbs with price. Here, leverage is being flushed out without a price collapse. This tells us the market is quietly transitioning from borrowed momentum to spot-driven support. That lowers liquidation risk and increases structural stability. In plain terms, the market is becoming healthier, not more fragile. Signal number 2, high price, low confidence. With fear and greed at 24, the crowd is still defensive. Yet Bitcoin is nowhere near panic territory on price. This creates what we call a high price, low confidence regime. That means retail is uncertain. Long-term holders are not distributing aggressively. And price is leading emotion, not the reverse. Historically, this zone often resolves in one of two ways: a slow grind higher once macro pressure eases, or a sharp, short-lived liquidity sweep designed to force emotional capitulation. What it doesn't usually lead to is prolonged sideways decay. Signal number 3, macro stress without crypto capitulation. Let's look at the macro backdrop. India's equity market turned lower ahead of the Fed. German and Japanese bond yields surged to multi-year highs, signaling global rate pressure. Yet inflation is easing in parts of Europe and Africa, and trade balances are quietly improving in several smaller economies. This is a classic policy tension environment. Rates are high. Fiscal stress is rising. Growth is uneven. And yet Bitcoin is still holding near 92,000. That's relative strength under macro strain, a condition that usually appears late in consolidation phases, not early in breakdowns. This brings us to the Liquid Math AI Market Pulse Index. For Bitcoin this week, Liquid Math AI Market Pulse Index, 63 out of 100. Bias, neutral to mildly bullish. The model is signaling. Structure is intact. Sentiment is misaligned to the downside. Leverage risk is actively declining. Macro pressure is present, but not dominant yet. This is not a euphoric market. This is a market quietly compressing under tension. Final takeaway: what actually matters? Bitcoin is not being driven by hype right now. It's being supported by positioning quality, not emotional participation. As long as leverage continues to trend lower and price stays structurally intact, the base case remains controlled continuation, not collapse. The risk is not internal to crypto. The risk is external: policy, rates, and macro shock. That's where the next true inflection will come from. Subscribe for the next Liquid Math update and hidden signal breakdown in the crypto markets.